There you go.
Good morning, afternoon, or evening, everybody, and welcome back to yet another episode of the Winnipeg Market Watch podcast. Today, Denzel and I are joined by our friend and a returning guest, Taylor Keast. Taylor, welcome back to the show. It's a pleasure to have you.
Hey, good to be here. Thanks for having me.
No doubt about it. Now, for those of you who are unaware, we've got a very exciting episode here today. The benchmark price has hit a new all-time high, which is super fantastic. First of all, we're all really excited about that. But I would say the crazier thing about the benchmark price hitting a high in the February data set is actually all of the other data surrounding it as well. And we are here today to break it down. But guys, before we get into the specifics and numbers, I just want to hear from both of you. Denzel, you can obviously feel free to go first. What was your general reaction when this data came out on March 3rd?
Well, I was very, very happy to see the benchmark price where it is right now. This is something that we've been documenting since the correction back in 2022. Um, you know, Obviously going through that kind of a correction early on in my own career and or investing journey was well, there was a lot of lessons during that. And so I remember back in 2022 and we were thinking like, oh man, like I wonder how far deep this is going to go and where's the bottom. But to see it rebound like this and then have the runway to actually, you know, who knows, maybe another 5% or 7% in the next 3 months is insane. Your predictions of 472 back, when was that, in October or November of last year?
It was October, yeah.
Yeah, like there is a chance that that actually could we could be higher than that, you know. Not to say that it's a guarantee or anything like that, but we're in the middle of March or early parts of March, and we aren't really in like I would say the most optimal time to see the highest of the highs, right? Like if we just look at the chart um, over the past 5 years, for those of you who are watching and can see it, May 2022 was the last peak. June 2024 was the peak before that. And just after the correction, we had it in May of 2023. So, we might see like another 30 or so thousand price gains in the next, I don't know, maybe a month.
Well, good point to bring up. So when I predicted the market for the year, like the 472 prediction was where I thought we would end up by approximately June. But yeah, the acceleration is on track. You're right. And we may overshoot. I don't think we're going to go much further if we do, but we certainly have the setup to make that all possible. Now, Taylor, I'd love to hear your perspective on these matters. When you first saw the data, what was your initial reaction to the overall report?
It seemed like we were heading in this direction for a while. But the fact that we're already here in it's not even the spring market yet. Interest rates aren't necessarily a whole lot lower than they were. There's a lot of factors that it's kind of crazy how fast it's accelerating, and I'm interested to see where this is going to take us. But I just didn't expect us to be here right now, before a spring market, before a summer market, before we have some bigger rate cuts or quantitative easing taken into effect. It's we're primed for a pretty good summer.
Couldn't agree more. And the points that you brought up about the Bank of Canada activity and some of the things that we're likely to see on the horizon are definitely things that I consider, as we'll get to in the article here. But I think that that's a really good summary of some of the details here. So for those of you who don't have eyes on the screen and are just listening, I'll report the numbers to you directly here. The benchmark price is up about 3.15% month over month. It was 1.88 last month. That brings us year to date up 5.09%. The benchmark price currently sits at 436, up from 422,700 in January. This leaves us over 3.42% above the 2024 high, and now officially 1.61% over the all-time high. Now, I thought that some of the context for what was starting this rally, first of all, I've been discussing this on Substack for a long time and with both of you guys individually and on the podcast. But the market factors that I think really shaped the gains for this particular month are mostly Bank of Canada driven from the past. And most of the Bank of Canada's action, in my opinion, is in response to economic and political factors that are outside the realm of Winnipeg real estate in general. Now, what do I mean by that? I mean that the rates are being lowered not because the Winnipeg real estate market needed rates to be lower, but rather for other reasons. Canada writ large needed rates to be lower for one reason or the other. And we are simply experiencing price gains as a byproduct of the affordability from other factors. Would you guys agree with that?
Yeah, absolutely. I think that with everything going on in the world, and we've talking a lot over the past 2 weeks, Keenan, about how what's going on in the U.S. is going to affect us and how the central banks are going to react to that, is particularly in Canada, right? So,
Mm-hmm.
um, you know, just thinking about how things could possibly play out over the next, let's just call it 6 to 8 months. I know for sure we're expected to have a rate cut again next week. I mean, that's what the economists are saying. And
Yes.
all that's going to do for Winnipeggers, I mean, obviously, we're not reporting on the bigger markets like Vancouver and Toronto, because literally every headline that you see with regards to those markets is doom and gloom, right? Um, but Winnipeg, particularly, it's just going to make things more affordable, right? It's going to encourage buyers to, get that pre-approval. There's going Even right now, there's a new wave of first-time home buyers. I have a younger brother. He's 25, and he's talking about buying his first place, and so is everyone else, kind of in his age group, right? So, however many people that is, I'm not quite sure, but you talk to anyone in real estate right now, everyone's super busy. You talk to lenders, everyone's super busy. And that just is a signal, that we're in for what looks like a hockey stick like jump in prices, I think, over the next, again, 3 or so months.
I couldn't agree more, actually. And that whole first time buyers are re-entering thing, I think that at this point they might have an opportunity to make it happen. Unfortunately,
Yeah.
I don't know how long that opportunity will last. But Taylor, would you say that the political and economic factors I outlined are things that you're generally considering or agreeing with, or do you have another take as to why we've got the price action that we've gotten so far?
So I completely agree with the economic and political factors, but I think one big thing that doesn't get talked about enough is just the cost of construction, the cost of adding new supply, the cost of renovating a distressed house and bringing it back to livable standards, even just maintaining rental properties, meaning rents go up, and now and I think that's a big part of it. It's just I'm sure Denzel's had some renovations that cost a whole lot more than they would have a few years back, and it seems like now, if our benchmark is we're sitting here at 436, the cost
Mhm.
of getting, you really can't get much in terms of new construction at 436. So your new construction prices are pushing higher, and I think it's putting more and more pressure on the resale market.
I couldn't agree more. And I know that privately we've both had conversations about this. Like all of us, at probably one way or the other, some combination of two people have discussed this. But the factor of home prices for existing construction will have a hard time when they start bumping up against what it costs to build a home is a really interesting thing to consider, because it's increasingly getting more expensive to build new homes. And then the builders obviously know this, but people aren't always able to, from an income perspective, keep up with the pricing gains that they need to actually make any kind of margin. So they start deteriorating things about the product to make it more affordable, i.e., offering less as kind of standard, or making the homes smaller, or making them on smaller lots, or building more attached homes and townhouses rather than detached homes, just to keep the price point down. Now, the fact of the matter is most Winnipeggers want detached homes. That's what this whole city is fundamentally. And that's what we talk about when we talk about our market report, because traditionally speaking, there is not actually a lot of condominiums out there in Winnipeg that are desirable by most people. I don't know if that's entirely the right word, but I used it. So there you go. And there's not actually a lot of attached homes out there that people consider when they're making market decisions, which is totally not the case in some of the bigger cities. But what I think will be interesting is whether there will be a push for the builders to start building the more affordable semi-detached stuff, just to make it possible for the people that can't quite buy a benchmark home, as the benchmark tends to rise over time. But anyway, that's my take on that.
I just want to add something. You know what? I think one thing too, where this all, where we're a little stuck here is I think when COVID happened, people took their listings off of the market because they were afraid of a pandemic, right? They were afraid of getting sick. They didn't want people in their house. And that took off a ton of supply. And unless homeowners in Winnipeg are incentivized to go and sell now that the rates are coming back down and it's easily noticeable from the average person, going about their life and maybe not even super aware of what's going on real estate wise here in Winnipeg. Um, Unless those people, get out of bed and they're like, okay, we're gonna go and sell, and we have this massive um influx of inventory. I think the supply picture is going to stay tight for a while. Like we would need to be, I don't know, maybe the rates would have to go back up again. And then while that was happening, people would be having to list all at the same time. Like there's a lot of things that would need to line up in order for us to fix this. And I just don't think it's going to happen anytime soon. I think that anyone who's, in the line of work of fixing and flipping or building and stuff like that, now's the time to be looking to buy some stuff and sell. Like this is exactly the market where you could literally buy something and in 2 months probably see your house value go up by 20 grand or so and doing nothing. And that's just because the demand's there. Uh, yeah, so I just wanted to add that because although we could build more, ultimately, like those houses are still going to be, 350, 400, 425, 450, depending on where we are in the city, right? If anything, people are
Usually,
probably going to have to move further out, right? To Highland Point or some of the new developments that they have going on here in the city.
and even those are still priced like closer to 5 for the most part. Like
Yeah.
detached stuff, or the attached stuff, maybe not, but I get what you're saying. Like the price point is already so close. And yes, I agree. There's not really a very high likelihood of more supply flowing in, at least not that I'm seeing. Um, any take on that, Taylor? Do you see a method for significant supply to enter the marketplace anytime soon? And by anytime soon, I mean like in a year or less.
Not unless we have some big changes from a zoning standpoint, I think. And then the question is that supply what we're actually wanting in the city, right? Let's say we can build a whole lot of townhouses or semi-detached or more mid-density housing. Is that what people are going to want to buy? I have a hard time seeing that. I think it would take a long time for home buyers to start coming around to the idea that, oh, I actually want a new semi-detached instead of a nice, benchmark price bungalow in a nice suburban neighborhood. I have a hard time seeing our buyer activity moving towards that quickly.
I agree. I think people might settle for it, but it'll never be a first choice. And when you start getting to like we're going to actually talk about this later as it comes to individual areas, but I think when you start having conversations with people about, are we settling for this or are we buying this because that's what we're looking for? That's where I think things are going to get really interesting. And then the future of the market will probably be more about, human psychology rather than actually, supply, which is discussed obviously a lot and it means a lot of different things. But to kind of, continue the supply conversation, I guess this is the right way to put it. One of the most notable things that I noted in the February data, especially versus the January data, is the rate of listings coming to market didn't change super significantly. The overall activity month over month in terms of both number of sales and number of active listings is similar. But this February versus the last three features a lot less total listings, and the rate of new supply entering the market is virtually identical. This to me means that virtually nothing is sitting, and the other data supports that as well. And I'm curious to see how the summer behaves in a market where, for the previous 6 months, I'm now talking about life as if we're in July or August here. What is the market going to do if virtually nothing's sat? Because that seems to be the direction that we're going. And that's, I think, the heart of why I thought 472 was real back in October. I kind of expected this early run up. And looking at my Market Predictions 2025 article, I predicted on a plotted line by month what exactly the price would be literally every single month until the end of the year. And for February, I actually had us at 440. In March, I had us at 450. So I'm a little low so far in terms of that, but who knows? I was also actually, I think January, I predicted us pretty much bang on just over 420. So anyway, that would be something to consider as well in terms of price action and how's the summer going to react if nothing's sad. Any thoughts on that, you guys?
Well, I guess going back to COVID era real estate market, that just led to a lot of bidding wars, a lot of kind of maybe poorly thought out buyer activity sometimes, maybe some overpayment, maybe some waiving conditions, that kind of stuff.
Mm-hmm.
I mean, it looks like we're headed back towards that type of market. What that means as a buyer, I think it's going to be pretty tough out there, especially if you're looking for your typical starter home, somewhere around that benchmark price. I have a feeling that that's going to be a pretty tough market to buy in. That being said, on the sell side, if you're transacting, if you buy right, the sell side should be pretty good this summer. So I think it's gonna be tricky if you're looking for the same type of house that everyone else is looking for, something that's move-in ready with the X amount of square feet or yard, detached garage, the standard benchmark home. I think would become I think it'd become a pretty hot commodity.
Couldn't agree more. And we already know that it is. It's been the case for a long time that the chase for that kind of Winnipeg gold standard 3 bed 2 bath 1,000 or so square feet with a garage anywhere safe has been something that even in the slow times, particularly late 22 and late 23, um, people still fought over those sort of things. And I would say as home buyers, you're in for a tough one. And as investors, if you can buy those things for a fair price, those are the flips you should be taking. Like especially if you're having any thoughts about holding for the long term. Like if I were to build a real estate portfolio right now with Winnipeg property, I would still to this day focus on those kind of houses because they're not making them anymore. And if they do, it's going to cost a lot more than their price currently. You know what I mean?
Yeah.
Yeah. So funny you touched on the bidding war thing as well, because it looks like in January, I wrote in the article that with so many houses selling basically right at list price and, somewhat less selling at asking price, I noted that I felt that both buyers, sellers, and realtors had a pretty commensurate understanding of value. And that was what was driving the market, that people were listing fairly and people were paying the ticket without thinking too much about it. But that trend got totally blown out of the water in February, where all of a sudden we had a very significant increase in homes selling over list, far fewer homes selling at list price, and significantly fewer selling under list price. Now, we're at the point here where we just had the February dump. We're into the first week of March. It's the 8th of March, 2025, when we're recording this. And we're in a situation already where more than half of homes are selling at or above list. Now, for those of you who are unaware, we don't say this because we think that every bidding war means that somebody is paying more than the house is worth. No, we're saying this from a pricing strategy standpoint and who's effectively moving units at different asking prices. But when you're in a situation that you're able to price low like that and be bid up consistently, that is a sign that a market is heating up really quickly and it can lead to accelerated price growth. If you guys were to list property right now, what kind of strategies would you be thinking of going? Would you want to try listing higher and going low? Would you want to be the one guy that lists approximately at value, holds off showings until an open house happens and then take offers? Or would you run the offer date strategy like so many sellers in the market are doing right now?
For me, it would definitely depend on the area, and what we were selling. For example, like we had a house for sale in Old St. Vital, and we were certainly priced far above what a lot of other people thought the value was, when we initially purchased that property.
Me too, actually. I was
And
one of those people.
and
No.
we exceeded that sale price, or what that expected sale price was, by about 40 grand. Um, and could we have done even better than that? I think there is a case to be said about it. Certainly if there was more offers on the table, but that's why it's important to um, in a market like this, when you're trying to maximize what a property could sell for, the marketing piece by your realtor is like so important. And how they're going to market it is so important. Um, but having said that, we went with the strategy of like listing high and just with the expectations that we'll wait until we get our number. And we did. We sold on offer night for full ask. Again, we were priced high, so anyone writing would have probably, I would hope, hear that from their agent and say, hey, this, just so you guys know, like, this is a number that's quite high for this area, so just be aware that that we're paying a lot for this thing.
Mhm.
I had another friend of mine who had a flip over in I think it was again in Saint Vital, um, and they had tried the bidding war strategy, listed for 499, got multiples. I can't say the number because it might,
No, be
whoever
fine.
listens to this podcast might know which property I'm talking about. Went 499, and they actually had, yeah, multiple offers far over ask, about 8 to 10% over the asking price, and they declined it because they actually wanted more. Um, that particular seller sat on the market for another 2.5 weeks, and I'm pretty sure that it's pending now, um, somewhere in the neighborhood of like 560 to 570. So that bidding war strategy didn't
Yeah.
work, but had they had started high, maybe they could have reduced the time that they were in that deal just by asking for what they wanted. So I think it just depends on where the area is. Um, with the rates coming down, most sellers can expect that their buyers are going to have more buying power. What was once just a 450K pre-approval is now 480, right? And by the time we reach the summer, provided these expectations of where rates are heading, that 450 could be 500, and so yeah, it's I think area dependent, and you really need to take a really close look at what's available and what you have.
No doubt.
Um, yeah.
Great answer. Taylor, if you were to sell property right now, how would you go about it?
I think Denzel's about bang on with that. It does really depend on the product that you have, but I think one thing we discussed in the past uh, that I kind of took to heart a little bit was you have to be willing to take your asking price. So I think there's a point where if you're going to list super low and you might not have that ideal product, there might be weird floor plan or less desirable area or whatever the case may be. Um, the missing the bidding war is not the best outcome. So I think if you have a really desirable product, if you have the prototypical 3 bed, 2 bath, 1,000 square foot bungalow, I think you could go about that and list lower. But if you have a product that's maybe a little less desirable, I think you just have to list at what you're willing to take, factoring in, a few percent for concessions and go from there. I don't know how much of a bidding war you would get if you're, let's say, trying to sell in the 250 range, but I think it does depend on how the market shakes out here in the summer.
That's a good take. And Taylor, I know we talked about this again offline, but there's been so many times in that lower price category for Winnipeg where you can almost just say, hey, here's a livable house and here's a number, like take it or leave it. And people who are just pre-approved to that without thinking too much about value will say, well, I can afford it, and therefore they'll do it. And I think
Yep.
that all of us have seen that several times, actually, with several different properties that maybe on the surface shouldn't have comped out for what they sold for, or didn't, or we didn't think they would, but it was close enough that someone at that time just said, fine, it's a buy. And this year, especially, I'm noticing that a lot more. In fact, there was one sale for a partial basement, 1.5 story in 5E that cleared 300,000, which is crazy. That had
What?
never even been, yeah. I was going to do that. That had never even been something that was remotely close to having happened. And
How big was it?
I'll pull it up. I don't.
Sorry.
I definitely can't share
That's
the
that's
address, but I definitely remember that sale, and it's just so wild to me that something like that can even happen. I want to know first of all what the situation was. Like maybe this was the buyer's childhood home, and they were trying to buy it back. Maybe there was some extenuating circumstance that if they didn't get this, then they were homeless. You never know what people's situation really is in these matters, but when you see a
yeah.
sale that high, you got to strongly stop and go, okay, this is nuts. All right, here it
Yeah.
is. This house, again, I'm not saying the address. This is a 1.5 story property in 5E. It was listed at 240. It sold for 311,000. This property had a partial
Crazy.
basement. That is all it
Part
was.
basement for 311 is insane.
Yeah, it's being emailed to you right now, Denzel.
Yeah, 1,000 square feet. So that's
Yeah.
that's not exactly a that's the price per square foot there is crazy for 5E.
No kidding. Like I've never seen anything close to that. Like I actually thought there was a typo on the first digit. There wasn't. I thought it was a
Crazy.
211, but no, that's legitimately a three. Literally a three. Crazy. I know. But yeah, that's just how it goes sometimes. Like people will just buy it because they can afford it and they like it. Whatever. It is what it is. So that's the state of affairs here, boys. Now let's talk about specific areas. Obviously, we're only using data from the first 60-ish days of the year, so there's a lot to be determined. And for those of you that follow, I'm going to do another um, sales by area market overview next month once we have 90 days and a little bit more data for every MLS area to talk about some of those in greater detail for those of you that find that valuable. I know a lot of you reach out and asked where it is this month. We're delaying it one more month, so the data is a little bit more comprehensive. But here's a trend that I found in most of the neighborhoods. First of all of the popular areas that were popular last year, with only a few exceptions, are doing great. Absorption's very high, and if they're not on the short list that I posted on the Substack article, the reason is probably that there just haven't been enough listings yet for it to qualify. There's some very, very good MLS areas that literally after 2 months have not yet had 5 sales. Crazy. Some of them also haven't had 5 listings. And that to me is just another symptom of the tight supply that we're experiencing. But the trend that I found, and I wrote pretty extensively about in the article, I encourage you guys to check it out, is there's a lot of neighborhoods that would be considered people's maybe third or fourth choice if they had to choose, that were experiencing absorption that was near perfect for the year. And some of those areas that I'll talk about explicitly are 4D, 4C, 5C, and then to a lesser extent 5D, 5A, and kind of those surrounding areas. Now, I want to hear from both of you. What do you guys think when you start seeing areas like 4C and 4D, or 5C for that matter, going as crazy as they're going? These are areas that typically are in the 60 or 70% absorption, and we're talking about absorption in high 80s or even high 90% ranges, especially for 4D, which has had nearly perfect absorption year to date. For those of you who don't know, that is West Kildonan and Scotia Heights. Any thoughts on that, boys?
Yeah, I
Well,
think. Oh yeah, go ahead, Denzel.
no, okay, thank you. I was gonna say, you know what, for me, what that signals is just simply, again, buyers are priced out of the more favorable areas, right? And so what they're having to do is come down in terms of their expectations of where they're going to be able to buy, and then move more into those tertiary markets, right? For someone who is shopping in somewhere like Tyndall Park, I grew up in Tyndall Park, and I know that there's a lot of people who would like to live in Tyndall Park but can't pay the Tyndall Park prices, and so they go and shop in an area like, or a neighborhood like Brooklands or Weston, because it's still somewhat nearby where they want to be. And so what it tells me is the market's tight, and for every house, there's 10 buyers for that thing. Tyndall Park, um, there was a foreclosure sale earlier this year on eGez, and there was 10 offers on a house that needed work in Tyndall. Listed for 299, goes for 360. And so that's a house that needs 35 to 40K, right? So those people who are looking to buy that thing, obviously it's a mixed bag between investors and just buyers looking for a home. They're going to go into the next nearest place where they can afford that and reduce their expectations, because how many people are there out there with like a 250, $300,000 approval, a couple or someone who's just starting off their career, a single person. Like it's not hard to find someone with that kind of affordability these days, right? Like Keenan and I did a deal off market in on college, what in the 400 block of college. And for those of you listening, that's not necessarily everyone's first choice to move in terms of buying their first house. But the fact that we were able to locate a buyer and pair them up with the seller, before, like without even going to the market, says something about the activity out there,
Mm-hmm.
right? And from what it sounded like, it wasn't that hard to get that buyer to make a move on that thing, because that buyer knew everything else that he was looking at was broken, right? Like,
Yes.
250K house in St. James, like, yeah, that place is probably not straight, right? Or it needs 60, 70 grand to like get it to where you want it, so now buyers are having to look at these areas where they can get a little bit more value, right? And hopefully less competition.
Good take. Taylor, love to hear your thoughts on the matter.
I pay a lot more attention to some of the more central neighborhoods in the city. I'm a lot less involved in a lot of the periphery neighborhoods. But one thing I think is happening too is people are starting to. I think the market can be relatively efficient in terms of buyers picking up what kind of neighborhoods they'd want to be in. And I think a lot of these areas are a little more desirable than maybe the price reflects. Like for example, Glenelm. I think Glenelm's a beautiful neighborhood. You get a nice character home there, centrally located. Relatively safe and low crime. The neighborhoods like that, neighborhoods like 5C or even 4C, I think. Um, if I think that if you're buying for value, if you're looking for a place where you can comfortably afford your mortgage payment, or even as an investor where your price to rent ratios are good, I think that some of these neighborhoods might have been potentially undervalued or at least underappreciated. And people are starting to pick up on that as prices are getting higher and as people are starting to feel squeezed just with cost of living and affordability in general. I think these neighborhoods will start to gain more traction.
I couldn't agree more. And the market is already stating that that's the case. So I've discussed this on the podcast before, but I'll repeat it for those of you who might not have heard those specific episodes. I have taken the position for years that the Winnipeg market is actually defined by the entry level housing price category and not necessarily the middle market. And the reason being is I believe that because Winnipeg housing is a home first and an investment second, although I do believe as we financialize, that could change very rapidly, that the market will have a cascading effect where as long as the least expensive housing that's habitable in relatively safe areas is being bid up, that money will move in an insular manner from area to area, climbing the price categories as people improve their own living conditions. So when I see sales like $250,000 5E houses selling over 3, or 4D and 4C at 88 and 96% absorption, or 5C over 90% and average sale price climbing steadily, that to me is a huge indicator that all of the middle market areas are about to get pummeled in a seller favored way, I should say, where they're going to see some really big price increases because those people that just came from that lower quartile of the market are probably now in a position where they ended up with more than they thought after they sold. So they've got more down payment, which again, for most people is going to be rehypothecated between 5 and 20x. Every dollar you gain on a listing sold is very, very impactful if you're also a buyer. And again, this market is driven by home buying. When that happens, that's, I think, a big part of why we saw such crazy gains in the benchmark price, which is a median, by the way. And when you look at the average sale month over month, I think it was almost a 10% increase straight up. I think the average sale in January might have been in the 410, 412 kind of range. And then the average sale in in February was closer to 458 or something like that. That's an average. So when I see that, like, we could easily have a case where, as this money keeps climbing the ladder, this could be totally crazy. But I won't opine on this much more. I just figured I'd mention that the mechanics of our market are such that that is very realistic. And I don't know, any takeaways from any of that? Any response in general from either of you guys?
Yeah, that's a good
Nope.
point. I mean, every sale in the lower price ranges, if you're on the sell side in the lower price range, you're on the buy side and potentially a higher one, right? So that makes a lot of sense. And maybe these areas, like looking at some of the highest absorption is some of the slightly more affordable neighborhoods. And I think as we get into the summer market here, it'll probably start pushing its way into some of the higher price range markets.
Yes, no doubt about it. Denzel, anything to add on the matter?
Nope, you guys pretty much hit the nail on the head there.
Okay. Well, that's the biggest chunk of the market update to kind of break down here. Now that we've had quite a while where we've been separated from our most recent market predictions, I'd like to just take a second and go over a couple of chances to update what you might have thought. Denzel, in October and again in December, when we had this conversation last, you mentioned that you thought our market would top out between 450 and 460,000. Knowing what you know now and seeing what you've seen so far, are you feeling like you're likely to be wrong on the short side, wrong on the long side, or do you still think you're going to be right?
Uh, I still would say that, well, I don't know, man. It's really tough to say. I think that there's a there's an even stronger chance that we're going to surpass even your predictions of 472 at this point. If we were to see price gains, what was it month over month this month? 3%?
The benchmark was 3.15, but the average sale price from January to February was actually a little over 10%.
Yeah, so if we continue this path here, like there's there's a there's a world where we're in, the 480 to 490 range. Provided again, once the rates come down and that's going to allow other people to afford more, what's another 10, 15K in a bidding war if that's what's going to get a deal done, right? Like you
Mm-hmm.
said earlier today, it's more about it's not everyone in the market is out there to buy an investment. They're looking for a house, a home, right? Somewhere to live for the next 5 to 10 to 15 or forever, right? So with that in mind, I think about my situation and my growing family that I have here at my home, and it's not even about the money, right? It's
Mm-hmm.
about the living situation, how we need to improve that, right? And so, yeah, I think at this point, I'm going to say that I'm actually expecting us to see an even higher benchmark price prediction. We have another $32,000 or so to go before yours becomes, you know, true. But with the way the market's heading and the fact that we're not even in May or June, guys, like we're so far from that, um, we could easily be at 480. So I'm gonna say 480 now today.
Okay, you love to hear it. Taylor, I know we didn't ask you in December, at least not on the podcast, but what do you see happening by the end of spring or the summer season this year?
I think if things keep going on their current trajectory, I think your range is somewhere around 470, 480. I think is pretty realistic. One thing to note though is I think a lot of people are betting on rate cuts leading to lower fixed mortgage rates. And there's a chance that that doesn't happen and we end up with a similar rate environment that we're in now. Potentially a 4% 5 year fixed is what we're looking at going forward. If bond rates don't cooperate with the Bank of Canada's rate cuts. So it'd be interesting to see what this market would look like if we were to have mortgage rates stay flat or even increase slightly. I don't know if it would slow down the trajectory too much, but I think it would kind of affect that top end number where everything tops out.
I think that's a really good point to bring up because technically you're right. Anything is possible, especially in the bond yield world, and when you consider how that impacts mortgage rates. it is important to consider, like, even if the Bank of Canada does cut, what if that doesn't really impact the market for what mortgage offerings look like? And I don't know necessarily what that would look like at this point, because so much of what's being discussed right now is revolving around the entire market expectation being that rates are going to continue to fall. The translation of the Bank of Canada's rate to the mortgage rate is, I think, a little bit more tenuous. However, I've seen predictions from different institutions that are very credible that suggest mortgage rates can be anywhere from today's number to 1.5% lower in 6 to 12 months. And no one can know. The question is, what side of the risk spectrum do you want to be on, and what camp do you want to be? Do you want to be the guy that is prepared for rates to be possibly 1.5% lower, mortgage rates, I should say, not Bank of Canada rates, being 1.5 lower, and then being ready for that market? Or do you want to be the guy that says, you know what, I don't think anything's changing, and that any price gains here are possibly fleeting? You got to do what's right for you and your business. But ultimately, I don't know what I would do if I were buying a home for the first time. I do not know that I would want to necessarily fix here. I would probably go variable depending on what the gap is, but it's
Yeah.
it's an interesting piece. And I am glad that you brought that up, because I do think that is something that's under discussed. Any thoughts?
Yeah, I think when everyone's on one side of a trade, it's just important to kind of look at when everyone's set to one side of the boat. It's just important to see what would it look like if this doesn't play out according to projections, right? Not to say that
Yes.
it will, not to say that rates are going to go up to 10% or anything, but when everyone starts leaning one way, I just kind of like to what if, right? What if this
Right.
doesn't quite work out as expected?
So that is actually an interesting thing to talk about at this point, because I've been asked by a lot of people, Denzel included, what I think is going to happen after this summer. And my consistent answer so far has been, I need a little bit more information. We're in a little bit too of a chaotic time to be able to look that far forward with any kind of certainty. There's too many factors. And nobody really gave any kind of indication as to what's, quote unquote, pardon me, what's supposed to happen. You know what I mean? And if there's no roadmap that anyone's giving clear direction for, it's hard to truly know. But I probably around the summer, following where we usually see our yearly high, which is, again, as we stated, sometime between April and June almost every single year, I'll write an article about where I think we're going from here and what I think that's exactly going to look like, because I'm not totally sure there's significant future gains immediately set up to keep staircasing forever and ever. But I also don't necessarily know that I think we're in for a huge pullback, especially not one like 2022. But we might see a more modest pullback like we saw in 23, where prices did fall and we did build up a little bit of supply. But then quickly in 2024, it got gobbled away and prices went right back to where they were anyway. You know what I mean?
Mm-hmm.
But anyway, something to consider. We'll dig into that a little bit more as time goes on here. So I wanted to transition this conversation while we still have a little bit of time. Are we guys? Is everybody still good to keep going with this here? Is anybody pressed? Anyone have scheduling issues?
Nope, no, I'm
No,
good.
we're good.
Okay, excellent. Taylor, offline, you and I had a little bit of a conversation on the phone about a topic that we thought would be really fun to talk about on the podcast for especially the young people that listen, and that is scaling a business as somebody in their 20s or early 30s. Now, all of us in our own way have our own business. We're all essentially independent contractors, business owners, or tradespeople of sort in how we operate. And Taylor, you have done a really impressive job of, first of all, managing your capital in terms of dollars, but also managing your personal capital in terms of your time and how you spend your energy. And I'd like today for you to chat with Denzel and I a little bit. And Denzel, I of course want to hear your take too on the matter about how do you balance being so many things to so many different people while maintaining your real estate business?
It's a never-ending struggle, right? I think we all run into this where you have to wear a lot of hats at the same time sometimes. Um, To me, a big part of it is always being able to zoom out and focus on what's important. I've learned to say no to a lot of things where I used to say yes to everything. Now I'm kind of being a lot more conservative with what I'm committing my time and energy to, which I think is important. You can get yourself into a spot where you're doing too much and you're less effective in everything that you do. And I think it's really important just to focus on making sure you're effective and efficient in your particular direction that you're going. So, for
Mhm.
example, Keaton, you could probably branch your business off in 10 different directions at the same time. But then I think that you might suffer, your performance might suffer from a realtor standpoint, from the quality of
Right.
service and care that you can provide, right? And I think
Yeah.
that's the one thing that I've been really focusing on is making sure that my one thing is my one thing, that I'm able to still perform at a high level doing that.
I think that's brilliant. And I'm really glad that you brought that up because I do see a lot of young people try to just take something, throw it at the wall, and just see what sticks. And they find something that sticks, but then all they know is how to keep throwing stuff at the wall. So then they end up finding something that could be really good, but they get distracted and they start doing way too many different things that may or may not even be related. And then they never take any of those to the next step. And they quickly end up in a situation where they're just okay at several different things, but have never really built that professional expertise at their true craft. And personally, I think both of you have done a really wonderful job of staying focused on the task at hand and really honing skills at specific things that are related and are sensible for both of your businesses. And personally, I'm trying to be that way too, but we all know how easy it is to get distracted. You know what I mean?
Mhm. Yeah. Um, yeah, I think for myself, especially now being a dad, my life is completely different than it was even just 5 years ago. Um, I think in order for you to find success in both scaling a business or even just being a successful business owner, you really need to master your emotions and handle stress and the way that you handle stress. My life is there's a million things that I need to do almost every single day. But what I came to terms with, and maybe it was a couple of years ago, was that I simply can't get everything done in a day. With the amount of business that gets done, it's impossible for me to just take care of everything in one day. And the more you can let go of the fact that you're not superhuman and that you're simply, um, you have the same 24 hours as everybody else, get what you can done at the best times that you can stay focused, right? So for me, that's usually from like 10 to 2 p.m. I'll do a lot of my um, you know, high priority tasks that require a lot of energy, right? Mental energy, and just do as much as I possibly can during that time. And then anything else after that, obviously the three of us could agree that you never really stop doing business. You can
Yeah.
certainly casually do things at 11 p.m. at night or 1 a.m. in the morning. But like when you're firing and you're going and you're doing the thing, it's usually during, business hours, right?
Mhm.
Um, and then when you get home, you got to make sure that you got to take care of your family and take care of yourself. And I think a lot of young entrepreneurs, they try to drill this almost inner voice that's like a drill sergeant in the army and say, you got to do this, you got to go to the gym, you got to, do all this Andrew Tate stuff, right? To be successful. But that's not the truth, right? Like I think it's more about um, you know, operating with an expectation that you're going to do the absolute most you possibly can, and then being okay with not getting everything done, knowing that you could pick up right where you left off the next day. Because if you could just get like a little bit better or move the needle a little bit every single day, you're making progress, and that's better than anything. And I think that's what's allowed me to keep a level head in some of the situations that I've been in, knowing that, it's this is some things aren't even in my control, so there's no reason for me to stress out about it. And for the things that I do a good job in those. Um, yeah, so that's what I think. And so when it comes to scaling and wearing multiple hats. It's just knowing that you're going to do what you can that day. And if you can't get everything done, don't beat yourself up about it.
I think that's really a very important message that I think a lot of people out there should take to heart, regardless of their age. But a big part of that message that I just wanted to reflect and state pretty openly here is it's more about consistency and stability than it is necessarily about short bursts of effort and 3 18-hour days followed by 3 days off. That's not what we're trying to do here. Growth in business, I think, is about a lifestyle and about cultivating something that you can go to bed knowing that, yeah, I didn't get every single thing done, but I put myself in the best position possible to succeed the next day and the next day and the next day sustainably. And I see people burn out because they don't know how to do that. And unfortunately, I'm going to say it, I think it's often, at least from Celia, hi, I know you're listening, but I see it with my wife sometimes too, that she'll really burn it to try to get stuff done and then really not be able to bounce back after. And it's hard. And we're both together working on trying to prevent that in each other because we don't want to see each other burn out. And as much as business is, at least the real estate side is my business, it's also her too. And that to me is something that I want to make sure going forward, like as partners, we can continue to scale. And Taylor, I know that you're involved with your wife very heavily in business as well. And I don't know if you two go through that, but I'd love to hear your perspective on how you guys approach the burnout and the time management aspect about what you guys do together.
I think burnout is one of the burnout's a constantly moving target. I think your capacity and ability to handle increased workloads can change day to day, week to week. And I think it's really important to have a pretty good internal thermometer to just to figure out where you're sitting and what kind of capacity you have to take on work. I think that avoiding burnout, even if you're less productive, for instead of working those 3 days on and then having to sit and do nothing for 3 days because you're so beat up, I think that you can be more productive working less or working more efficiently, more consistently.
Mhm.
And I think one thing that a lot of people don't it's what Denzel was talking about, the whole grind set thing. You have your inner drill sergeant that you should always be doing more, always be doing better. Not to get philosophical on you guys, but I heard a quote that's success is how you feel about yourself when you're by yourself, which is almost just the idea of kind of self-peace and being okay with where you're at. And I think a lot of people sacrifice that getting into business. They'll burn themselves out, they will burn relationships with friends and family and health and fitness and spirituality and whatever other areas of their life that would be important. And they sacrifice that all for the goal of more. And I don't think that's necessarily the best way to go about it. I think if you can keep a balanced life and keep um, prioritizing the things that are important to you, you can do a lot more in the long run. So that's what we try and do is we try and make sure that we are always looking back at what are we doing this for? We're buying rentals so we can have passive income and build a business that can build wealth in the future and not have the gun to our head that we need to earn this much money every single month just to stay afloat. And as long as we have that in mind, I think it makes everything else a lot easier. We're not doing this so we can go buy a Ferrari. And I'm not gonna, get fat and lazy and bad health and depressed and miserable just so I can have a nice car, right? I think there's a lot more to life than that. And it's not worth the sacrifice per se, unless it is to you, but for us, it's not.
Oh, it's definitely not for me either. And I see it so often where young people will really stretch and they'll go and they'll buy some ridiculous car or a house that's really, really hard to keep up. Like not even from a mortgage payment perspective, but there are people out there paying 5 figures plus in property tax, which is just crazy too, because that's some people's total mortgage payment in a year. And that's just taxes. So, I think about that and to me, it's like I wouldn't really feel good about that until much later, even if it would theoretically be possible now. It's just not a position that I want to be in. So I couldn't agree with you on any possibly more on that. But one theme that I've heard now from both of you is actually the kind of coalescence of physical health and mental health. And Denzel, we were at the gym right before we got on this podcast. So I know that lifting weights is a big part of your routine, but Taylor, what do you personally do in your busy schedule to try to keep your mind and body at peace and healthy despite all of the chaos that happens with being in the real estate business?
Uh, I mean, you get a little bit of that caveman mentality. It's good to lift heavy stuff.
Mhm.
You feel good. You get a lot of energy out. I think it's important to have a strong and healthy body. Also, I'm a big. I like going on long walks, especially at night. In the summertime, I'll go on a nice long bike ride. Um, I'll go no headphones, no audiobook, leave the phone at home, and just kind of have some time to kind of just mellow out and just to kind of reset a little bit. And I think it's important. You can get into a spot where you're thinking too much and consuming too much information and working on too many things, and it's important to kind of get back to a baseline. And I think that lifting weights and exercising stuff like camping and hiking and stuff, I think that's important to kind of it makes me personally more efficient when I do get into that uh more grind set mode where I have to work a lot and I have to kind of be the drill sergeant in my own to my to myself.
I love that. That's really awesome. And I didn't necessarily know that about you, but I also like the solitude of a really long walk without an audiobook, especially on a quiet night. And there is something almost like a, I don't know quite what to call it, but it's a serene feeling that you can only really get from like at least a partial connection with nature, even though I'm obviously walking in a very populated, relatively high density cityscape and going to whatever nearby park or whatever happens to be in the area. But you're absolutely right that it can calm you down and kind of give you a little bit of perspective. Like, hey, I'm just a dude walking around at the end of the day. Like, I know I've been thinking about all kinds of crazy things all day with business or whatever, but it's it's brilliant that you do that, and I really respect that. Denzel, I know a lot more about what you get up to, but what's your take on that? How do you keep a healthy body and a healthy mind despite everything that you have going on?
Well, I try to have, decent diet, which is a pretty standard thing. I'm not filling my body with a bunch of fast food, although there are periods in my life where um, I'm so busy that I'm constantly finding myself at a drive-through because I'm so on the go. But just making sure that I'm making the right choices with my diet. And then obviously, like I play a lot of basketball still. For me, that's a way for me to um, escape and not have to think about some of the things that I have going on. And it just makes me feel like a person. Like it's hard to do real estate and business 24/7. Playing basketball keeps me connected not only just with myself and what my past hobbies were before real estate, but it also allows me to connect with the youth here in the city. I coach basketball as well. And it's just nice to do things that are outside of business, right? Like whether that's, you know, going and spending time working on yourself or that's helping in the community in one way or another.
That's really good. And I do think that the community aspect is something that I should probably work on appreciating a little bit more because I sometimes find I'm a bit of a shut in. Like after being on the phone and talking to people literally all day, when I do eventually get back to my place and, Celia's home with me, uh, oftentimes we'll both just kind of look at each other. We'll be exhausted and it'll be like, hey, you go in that room, I'm going in that room, and we're not talking to anybody. And
Yeah.
I think those moments are important. But I also think that I could probably be doing a little bit more to be a community member outside of business. And that's something that I'll probably work on in the future. And maybe that whole plan will get kiboshed if and when we have kids anytime in the future. I know that that's something we're discussing at this point, but um, very interesting to think about just ways to make it a little bit easier to move on. As I know we all have very ambitious and very high hopes for our own futures, and we have very good goals individually to try and make all of this happen. So with that, I'd like to ask both of you kind of one last question here to wrap up this episode. Um, this is something that I've been asking people outside of the podcast a lot as well. But this got inspired by a lawyer that I really like. His name is Bruce Haddad. You should work with him if you're buying or selling. But he had a perspective for me one day when I was with him. And he said, by 55, I would just like to be in a position where I don't have to care about business anymore. I just want to be able to do whatever I like and live the rest of my life however I want. I want to know from the both of you, do you have a magic age that you'd like to be in a position like that by? Or is this more of just a goal of I'll take it as I see it. I'm going to move in a direction and it'll happen when it'll happen.
I'd probably say about 40 years old. I'd like to just kind of be able to, I wouldn't say kick back, but not work as hard. Not that I don't like to hustle and stuff like that, because I certainly do. It's fulfilling, absolutely. But if I could build up my investments and make some good decisions leading up to that point, because that's another 12 years away for me. Yeah, I think 40 would be fantastic. But although knowing me, provided nothing in my demeanor towards life changes at all, I'll probably still work just as hard at 40 than I did at 28. I don't know though. Who knows? I might have a couple more kids and life might be a lot different then. That's a pretty far ahead to look ahead into the future. You know,
Sure is.
I think 5 years is like a lifetime already. So even thinking about what my life possibly could look like at 33, if I were to just string together some amazing years in real estate and earn a lot, who knows, maybe 33 is at that point we could do what I want, right? So
Fair enough.
yeah.
How about you, Taylor?
For me, I think it's as soon as possible.
Taylor's right now. He's already living it.
I was gonna
He's going
say
to Mexico
so.
next week.
I am, and it used to be 30, right? And 30 was for whatever reason this number I had in my head when I was in my early 20s. 30 just seemed like forever away. Like, oh, I want to be financially independent by 30. And we're at a point where our rental income can cover like a pretty basic lifestyle, but if I don't do much and live cheaply, like I don't necessarily need to work. And that's not exactly, I still work quite a bit and still do more. So I think that there is going to be a point where I think it's going to start to taper, where I'm able to start doing a lot of things I enjoy outside of work, and then probably working almost as much, but just working in something that I find a little more fulfilling, not necessarily looking at money first. I think what Denzel does working with the youth in the city, I think is pretty important. I have kind of a vision of doing something like that with renovations, helping these young maybe kids with less opportunity, help them learn some real life skills. And that might be a business that doesn't make a profit, it doesn't turn a lot of money over, but it would be something that I'd find a lot more fulfilling. I'd probably still spend my days working, just not working with the goal of I need to do more or make more. I think there's a lot more to life than that. And business is great. And I have a lot more fun working when I don't need to make this deal happen just to be able to eat this month.
I think that's smart. It's a great perspective, and I like the idea of working for fulfillment rather than to maximize profit. I think that's it's really honorable. Any closing thoughts here from either of you
Oh,
guys?
what about you, Keenan?
Well, I guess I can answer too. I fully
Keenan's already living the dream, man.
I'm dying with my boots on, no matter what. I'm working until I drop, and that's not because like I'll need to work until I drop. It's just I'm very afraid of what will happen to me if I stop psychologically. I think it'll be really hard for my mind. So I agree. I think I might move to something where I'm like doing it more for fulfillment than it is going to be about money. But I know that there will never be a day where I say like I'm retiring and I'm not working. I'm going to join like a squash club and then read books and write and sip tea and play with the grandkids all day. Maybe I will, and I'm totally going to eat my words. But I fully expect that I'll be doing something all the way to the end, and that I'll hopefully just behave better because of that.
No, that's a good point. I think it's important to note retirement isn't necessarily doing nothing, right?
Yeah, that is true too.
I
Yeah.
think that's everyone's idea is, oh, I'm gonna make all this money and then just sit on the beach and drink a Mai Tai. And that doesn't end up working out that way, right? We're not really wired to do that.
And that's a good point too. That's not realistically how retirement looks for most people. So maybe the message I need to convey is I just want to make sure that whatever I do, regardless of financial position, that I'm always doing something. I know that I have to stay busy, because when I'm not busy, that's when I've got a very active mind. Like the wheels are always turning, and if they turn too fast in the wrong direction, I can end up on bad tracks. So I got to stay very, very focused and occupied basically at all times for my own well-being. And maybe you guys are that way, maybe not, but that's how I see it. So there's no year in mind. It's just do my very best and stay occupied, stay on track, keep behaving, and be good. You know what I mean? I will say though, we sure
100%.
did cover a heck of a lot in this episode. And I wanted to kind of just share the closing thought here that in February 2025, we've hit an all-time benchmark price high. And basically, besides a very small group of people on podcasts and internet forums, no one cares. It's not being talked about really. So I think that's kind of crazy. We'll see what happens in the next couple months. But anything else from either of you?
I'm just excited to see how
Just
this
trying.
whole thing shakes out this summer. I think it's exciting times. I know in the depths of the lows there, it seemed like we never get back to this point, and you kind of blink and we're right back here. So it's amazing how
Yeah.
quickly we got here, and we're excited to see where we go in the future.
Great answer.
Yeah. I think the way I'm seeing this opportunity is, I made mistakes during the first run up when I first started out in real estate. Now, having that, I went through a correction, quite notably, one of the worst corrections that we've experienced in probably 20 years in Winnipeg. And then now having to be able to look forward and almost not, I wouldn't say predict perfectly, but have somewhat of an idea based on some of the signals that I've been able to pick up on of how things are going to play out gets me very excited, because I now feel like when I'm out making decisions, they're well informed, and uh I just feel really, really good about what's about to happen. At least for anyone else, I'm sure most people could probably agree. If you are invested into the market and you have money in the market, this is an exciting time. It's your world. If you own real estate, you have what everybody wants. When the economy is chaotic and we don't know what's going to happen, real estate tends to do quite well. So yeah, I guess for my closing thought is I'm just really looking forward to see how the next 90 to 120 days play out. I'm sure we're going to be surprised by even more sales that are insane, and we'll be talking about what happened in March next month, and I'm sure there'll be some crazy stories.
No kidding. So for those of you listening,
Yeah.
thank you for sticking around this long. Make sure that you subscribe if you haven't, so you don't miss the next episode. And we're looking forward to chatting with you guys in future about just how crazy things ended up getting. But gentlemen, it's been awesome. I appreciate our conversations as always, and looking forward to chatting with you guys again real soon.
Yeah, thanks again for having me.
Right.
Absolutely.